Mr. Chris Frostad, how are we, sir?
G'day, g'day. Very good, thank you. It's
I
another
am glad to have
beautiful.
you here. I'm sorry, it's a bank holiday here, so you are unfortunately with me all by myself,
That's okay.
lonely. So this one may drag on a bit, folks. This one may drag on a bit. Even my wife's left. Right. Okay. This is the second in a series of four where we're sort of exploring basically how to invest in uranium juniors. In fact, I guess juniors more broadly, because there's a lot of moving parts, a lot of variables, and I think last week we talked about jurisdiction, record of the team. We talked about partnerships that companies sometimes get into, and today we're going to carry on that, and we're going to talk about the difference between drill ready, drill worthy, um, you know, and what the company controls. Such things like, do they control the land or do they option it? What are the kind of the costs and access if they don't, and basically may move into things like, how far along is the project when they've kind of picked it up, and or how far along is it when we start to invest in it. So without further ado, Chris, if you're ready, we'll start with the kind of the difference between these great phrases like drill ready and drill worthy. What do we mean by that?
Well, we've talked about some of this stuff before as well, and for any exploration company in particular, you have a set number of projects, and those are yours. That's what you got to work with, and something may or may not be there. So I think first off, if it's drill worthy, then it needs to be clearly explainable to an investor as to why. And that's missing a lot of things. Like if all you're seeing is geography or closeology, then that's a problem. And not that that's not important. If you're 2 kilometers away from Cigar Lake, that's one thing. But if you can't demonstrate why you think there's a connection between the projects and the properties, then you're just blowing smoke. So there really has to be that connection. And as we said before, you're looking for very specific things. If you've never drilled the area before, again, you want to make sure that there's been enough work done on it so that people can actually explain why they think this thing is going to take a drill. Because we said before, the cost of a drill hole could be equivalent to numerous geophysical surveys. It's the most expensive thing you can do. So, you've got to make sure, you're looking for structure. You're looking for, we're always looking for graphitic graphite in these structures. We're looking for evidence that there may be alteration. Those are the big things. But whatever they are, without getting overly technical, there needs to be a clear explanation of what it is.
Right. Well, and I think this is quite a good one, actually, because it's kind of representative of what we see a lot in this space, which is, technical speak for the sake of technical speak without actually being meaningful. There's no kind of "so what does this do for us" component to it, which again, talked about in the past. So, I might, some of my favorite ones. We've had technical success. What the hell does that mean? Usually means we couldn't find anything, but we've learned something along the way. These are phrases that you've got to kind of read between the lines with. So I think this whole thing about something being drill worthy, which is a kind of, it needs to have a few things like, the geochemical anomalies, geophysics, maybe even some trenching's been done for you. I don't know at what point you can enter this project.
We're not doing any trenching, but that doesn't mean that there hasn't been drilling done in the area. And of course, drilling is your best information. That's your best data. So if you're in an area where you're drilling for the first time, then to your point, you've got to have a fair amount of geophysics that you can easily explain to anybody as to why we think this thing needs a drill hole. And if it is the first drill hole, then measure your expectations, right? Because we're here to learn something. Whether there is in fact a structure there, whether that structure is in fact have associated with any alteration or any mineralization, and until you poke a hole in it, you really don't know. So it's not also about punishing a company just because they drilled a hole and didn't find anything. Your technical successes are important, and they're very important in terms of how that money gets spent after the fact. Where the next money is spent. I'd also say that, if somebody's drilled a property before as well, that doesn't mean that it's been killed. They may not have drilled deep enough. They may have missed the target, they may have whatever. But even that hole, having that hole to go back and look at should be providing important information as to.
Yeah, but we've got to be careful. We've got to be careful, Chris, because I think a geologist said this to me a few years back, and it kind of made me worry. He said, "Don't necessarily want to trust a geologist entirely because they get very excited about the rocks, and this isn't for them sometimes an economic process or program. This is just the thrill and the joy of actually drilling and trying to understand complex systems." And for me, usually as a money person, in fact, the person I did say this to, I had given money to, it was the last thing I wanted to hear, right? What I wanted to hear is, and I think it was Dave over at EMX, Dave Cole said to me, "We've got economic geologists." And at the time, I was like, well, what the heck does that mean? And now I know, because there's a certain amount of, there's certain sort of technical standards that I would expect to be met before drilling starts. But for most retail investors, that's the boring bit. It's like, we're not drilling, that's boring. Why is it not boring?
Because it was actually Phil Williams who we were talking to a year or so ago. And we were talking about a variety of things, but he finally looked at us and says, how do you get these geologists to stop doing what you're saying, to get all excited? Like, they'll find something and that'll be really interesting to them, and then they'll want to turn around and go over to the next tree and try something different over there. Like, how do you get them to stay focused on where you think the money is, as opposed to trying to reach out and learn something new and different and what have you? So it is a balancing act, and it does come back to one of the other things we talked about last week, is how do you balance between a company that's being run by a technical human being and one that's got more of a business bent to them. And that's that balancing act.
Well, yeah, because the other thing that happens when you move to drilling is that's the really expensive phase. So I kind of like the kind of multi-dimensional component of the data sets I gathered pre-drilling. I want to kind of almost cross-referenced against different means of gathering that data to increase the chances of success on that first hole. Because there's nothing worse than you put a drill into your most likely chance of success, and it comes up dry. Comes up, sorry, that's the oil term. Comes up as a duster. It comes out up with that. It isn't as you expected, right? And I think, and that's a real kind of depressing thing, because then everyone's sort of looking at the geologist going, "Sweet Lord, I've given you all of that money, all of that time, and the first hole didn't work out. What on earth is the next hole going to be like? Why is that going to be any better?" So there's a huge series of doubts that kind of spread and ripple through the organization quite quickly. But I guess there's enough examples where companies have gone on, after 6 or 7 holes to eventually find something. So it's not always, but
the other reason why
again, a lot of companies don't
answer the phone when they're up there.
Yeah,
they're getting calls every hour by the guy from the suit going, "Okay, what's going on?
Yeah,
leave me alone."
Yeah.
Figure this out.
Yeah, but but I like some companies don't get the luxury of having more money to kind of get after the next sort of 2, 3, 4, 5 drills, because because of that doubt. So it swings and roundabouts, and I guess you got to let the process play out. But for me, you kind of want a lot of work done pre-drilling, because that's when it gets super expensive.
Well, and that's why we're also, and I've mentioned this about us. We are doing a lot of drilling this year on more than one project. And some of them are early holes, and some of them are going to be, into areas that we understand a little bit better. And moreover, we're also sliding some of the geophysical work and the groundwork, the more boring stuff, in between all of that, so that our whole story isn't about, the progress of one particular project, which can become boring and seem like it's never going to end.
Never going to end. Time's a killer sometimes for retail investors. They don't want to wait around too long. Let's talk about, and that can come back to one of my thoughts around. So there are programs that I've noticed where the drill program seems to be based around hope rather than sort of technical de-risking. Do you see that? Can you believe that exists?
It's all about hope, Matt. That's what we sell here. Um, yeah, it's well, when you say de-risking, it's different, right? I mean, in exploration, yeah. I mean, if you're looking for that first real hole, that real good hole, you're not, de-risking is a funny term to use because it either is or it isn't where you want it to be. Once you've actually found something, it's how quickly, or you've hit that one good hole. Then then you want to see how quickly they're turning it into something, right? I mean, one good hole's a headline, but 10 is a deposit. So it's how are they advancing that thing along? It's hope in terms of de-risking. They've got to be. I mean, we're fortunate in our sense in that once we drill a hole, because we've got radiometrics, because we know what's coming out of the ground, we're making a lot of game day decisions in terms of where that next hole is and what we're seeing, and we're able to analyze it rather quickly and move around. And case in point, I think if you went back and actually looked again, I can use ISO as my example, but when ISO found the hurricane zone, they'd actually announced they were drilling down on the Geiger project. They drilled a hole or two down there that they planned, and then they jumped up and drilled that thing to the north, and found a good hole up there. So they really are. I mean, a good team isn't just setting up their program and drilling the 10 holes that they said they were going to drill. They're actually evaluating every hole as they move along because they know they've only got so much budget, so much time, and so many meters are allowed to drill, to find, to learn something important.
Yeah, but things like that it's got to be like factored in to the drill program when it eventually comes along, because obviously at the end of the day, the kind of cost and access to capital is what drives these things along. So, especially if you're dealing with sort of remote parts of the world, or even remote parts of Canada, when you kind of got these fly in, fly out, or these helicopter type projects, you've got to be even more certain than, say, if you're just jumping in a truck and driving up the road to
make sure. I mean, yes. So you've got a lot more. Yeah, you've got a lot more going on than that. I mean, when I say you're evaluating it hole by hole, you're not necessarily picking up the whole kit and caboodle and moving over to another project. You're angling your hole in a different way, or you're aiming it in a different direction, or you're going to come at it from a different direction. But you do have to be quite tight about what you're doing, because so many things can go wrong. I mean, we've had historically, we're going to go out and drill X number of holes, and one of them, they run into something that hadn't been expected. Might have been crazy unconsolidated sand or something, and all of a sudden you've lost so much metal down a hole that it's the equivalent of a hole, the cost of a hole. Like your costs can bounce around during a program, and so you've got to be very, very on top of those costs and what you're how that's moving along on a day-by-day basis.
But it comes back to how you evaluate. It's everything's risk. Everything's hope and everything's risk in junior mining, right? But if you've got a project which is, I say, remote, and it is helicopter time or fuel costs for generators that you need to kind of set up there, you need to have a slightly different approach from say someone who's just an hour's drive from I don't know, Vancouver, chasing gold. Because there's you don't get that kind of leeway. You don't get to sort of, I'll just pop back in the helicopter for the thing I forgot to bring up here just in case we spotted an opportunity. Do you know what I mean?
No, you're done. No, you have, your program has to be developed and planned a lot tighter than that.
But as an investor, I'm thinking you've got to think like that and say, right, you've got less chances, less ability to make mistakes and for it to kind of be blended into the costs. Your costs rack up and stack up quite quickly. So as an investor, you got to think, is that for me? And I know a couple of gold guys, as Uranium show, but the junior mining, right? Who have remote projects, up in the mountains. There's helicopter in, helicopter out. They're up there for days and weeks at a time. But they knew what they needed to find in terms of the grade, in terms of the intervals, in terms of the rocks that they're looking at, what would be economic and what would be just chasing hope. And you've got a tough decision to make at that time. It's got to go, this is not going to be economic. I can see it pretty early on as an economic geologist. I got to kill this thing. Otherwise, you're just kind of spinning your wheels like, on the old hamster wheel, just to kind of keep your job and keep the salary going, because you're not sure if you can raise the money to go and find another project to do the same thing, right? You see that a lot.
The question as to whether when do you hang it up on a project?
Yeah.
And that's a tough one. It's a very tough one, especially if you've been promoting it for the last 2 years or 3 years. That is tough. And, I'm not sure how an investor can look at a project and say, okay, they should have walked away from that one a year ago, other than the fact that they've been, selling the same story for 5 years. If that's tough. I go back to our case. In our situation, all of our drill programs right now have to be vetted by our partners.
Yeah.
Who aren't afraid to walk away from it.
But let's be clear. It's tough, right? It's tough financially because that could be the end of it, or it's tough emotionally because you're vested in it, or it's tough ethically because it may be the right thing to do is walk away, but you got to make a call there. And I think ultimately these companies don't make a call at that point. And that's the complex nature of investing. You're trusting people to make the right decisions with your money, to make the right decisions in terms of how long they keep chasing something, because otherwise we all end up as this sort of group of enthusiastic, hopeful individuals who collectively never make the call because the next drill could be the big one.
Well, yeah, and it's hard for an investor to internalize the fact that, and we know that from our side of the fence here, is how do you internalize the fact that the company you just invested in just gave up? Wait a minute. I mean, if you invest in a normal business, they don't just shut the door because nobody showed up today. To take your project, your major project, and go, okay, well, we're done here now. Because, and I've said this before, exploration companies aren't, and mining companies, which most of them are not businesses so much as they're just a single project that, that has a beginning and an end at some point in time. And hopefully the end is a mine running out. But, there's no way to regenerate a project once you've proven that it's not going to work out for you.
Yeah, I don't know. I sometimes, I think I've seen enough instances where the wrong people are making that choice. The wrong people are making the wrong choice.
You do have to make the choice at some point, or the choice will be made for you, and that's usually truly devastating. So, I think you're looking at companies that are trying to find the most elegant way of moving on. And either, what that means, moving into another commodity, moving into another project, moving into, another space, or just hanging up the shingle. Somebody's got to make that choice. And, to one of your other points, your technical people do get quite enamored with the project sometimes. They're just determined that it's just there. We just haven't hit it yet or found it yet or whatever. And all it's going to take is, one more hole, which turns into 20 more holes, which on and on and on.
Yeah. I don't know. I do struggle when I sort of see that, and it's hard. I mean, it is super hard because there's so many variables and everything changes on it. And I know this from my investment, this kind of copper company. It's like every day was a new day because the data that was going back could either fill you full of joy, or could absolutely just floor you because you're like, oh my goodness, what's going on now? What more money do I need to spend? I thought we'd already kind of achieved this, and then the next day it's like, oh my goodness, we've overachieved. So it's definitely hard work for sure. But let's talk about some of those other variables around those sort of cost and access type thing. And I know there'll be a lot of overlap with lots of the points that we're making across this 4 episodes. So when I'm looking at a company, so I'm looking at where it is, what's the kind of cost to doing business, the cost of mining. So those remote jurisdictions, sometimes for me, there needs to be a lot of other things that kind of make up for that kind of remote mining. And because it's not just remote exploration, should I say, it'll be remote mining at some point. You're going to have to build roads electricity and water and fly people in and fly people out at some point potentially, build stuff very far from where the materials are at the moment. So all of this is going to ask the kind of cost of it. So you just got to think about those things if you're going to stay in it for that long, along for that ride. But what about the kind of seasonality? I mean, Canada is extraordinary for its seasonality, and sometimes the rules that people outside of Canada might think of may not actually apply. So how does that affect kind of exploration programs?
Exploration programs, it in some cases it helps it, in other cases it hinders it. I think it's some of your programs can turn out being seasonal for that reason. The thing about Saskatchewan, I think, as we all know, is it's flat, very flat, and there's a lot of water, but they're puddles more than they are big deep lakes or anything. So there's water, there's streams, there's bogs, there's things that you're getting around. So from a seasonality standpoint, to a large degree, if you can drag things around on snow and ice, it's a lot easier, cheaper than having to helicopter it in. So that's always a component. And historically, not so much now as it might have been 20 years ago, you saw that almost, probably 80% of the exploration was going on in the winter for that very reason. A lot of it's changed. A few things that have changed. The other thing we used to do around that is sometimes we would strand a drill. And that is to say, because of the seasonality, there's certain times of the year that we're just not allowed to be out there because we're ripping things up. We're ripping up shorelines and stuff because it's either melting or it's freezing. It's in between. So yeah, there's a few months of the year we're just not allowed to be up there, or the caribou are wandering through that time of year. So in some of those cases, we've done this before. In the winter, you'd do your drilling, and if you wanted to keep going, you would strand your drill there, knowing that you couldn't get it out till the following winter. But it allowed you to get in there and do some work, do some drilling through the summer. So that was always an option. But more and more now, we're seeing a lot of helicopter work, a lot more than we used to see. And I think more than anything, it's being driven by respect for the land and by respect for the communities up there, where it's, I hate to say it's easier to get a permit if they know you're going to fly in than if you're going to have to break down a road, work in a road and set up a camp. But that, ultimately that's really what it's about is making it easier on everybody to environmentally and to the communities as to how you're doing your work up there. So there's a lot more of that, and that essentially increases your cost by about 50%.
Interesting. Okay, and what about situation? I always think grade and scale can solve for a lot of problems, right? If the kind of free cash flow on projects is significant, it usually solves for a lot of problems. But there are points where the capex, the entry point, is too much of a hurdle for people to wrap their heads around. And I've seen that in the last 18 months where I've got a whiteboard over there of kind of these sort of hybrid stories where they kind of started off big and they had to shrink the project dramatically to reduce the capex to a point where they could even think about getting it funded, because invariably you kind of got these $100 or sub $200 million companies and they need to raise $1 billion, $2 billion, and it's like, well, that's never going to work. When I was a banker, it was like, you kind of say the capex was, or the raise was, I should say the raise was sort of 3 times the market cap. You're like, nah, too risky. No, that's not gonna work, right? So, do you think we'll see more of this kind of hybrid working, like people just recognizing that money is tight, the cost of money is expensive, or we're going to have to find new ways of financing these much larger projects? How do you think it's going to play out?
I think the market's relying on us to figure out cheaper ways to do things more than anything. We've talked about depth being an issue. How deep is this crazy thing? A good example right now is Canalaska, who's tapping into something pretty significant, but it's deep. But there's a way to go at that, right? And that's what they're doing. If it may cost you $1 million to get that hole down there, but there's methods now of drilling whereby you now utilize that hole and you go down and you drill out from there. So you've minimized your cost of drilling than having to drill every single hole from surface. Another example of depth being an issue is Kiena. So Kiena is the deposit that's over near the Clough Lake area. Again, it's over on the western side of the province, and it's owned 41% by Orano and the remainder, I guess, is now UEC. But Iran put that thing on the shelf ages ago, and it's not a small deposit, but it's deeper than they feel is economic to go down and do much more work on it right now. Maybe that'll change as the the economics of the day change. But there are cost is certainly will certainly hold up projects.
Yeah, oh, definitely, for sure, and it's across all metals. I know you're quite brilliantly bringing it back to uranium all the time, but I kind of spin out into other metals as well, because we're seeing the same sorts of problems play out across the board, for sure. And just in terms of that, sticking with the money side of things for a bit, in terms of capital structure, burn rates, etc. Do you see sort of early warning signs for unsustainable burn rates? If you're looking at a company which is 20 million versus 100 million, and you're looking at their G&A, you're looking at what they're kind of ripping through in terms of their cash balance, etc. What do you look for?
Well, you can look, and there's a number of companies. I'll go into them, but I mean, there's a number of companies you can look back over the last 3 years. And if you start measuring the amount of money, not just that they're burning for overhead, but that they're putting in the ground, you can see it. You can see it coming down year over year over year. You see that because they kind of lose their enthusiasm. They fill up the bank. They run out there. They just start doing buckets and buckets of work. And then as they come to the end of that bucket of money, they start dialing it down. I think then they start getting a little bit more cautious as to how they're spending money and careful about how they spend their money. Back in 2022, 23, when 21 actually, when things started to take off and there was so much money being raised and it was being spent so quickly, you really have to wonder how wisely it was being spent, because there was just a lot of money being spent. But the other thing we've seen, analyzing, taking a look at market caps and share price change and the enterprise value, remove the cash, and what's the market giving your assets for value? It's all over the map. The market's been funny in terms of how it tries to value these various companies. And then it seems to be the only common element we keep coming back to is purely share price. It doesn't seem to matter what you got in the bank, how much, how little, or what your market cap is. It all keeps coming back to share price, which is very odd as I look at it, because the market seems to be confused as to how it values exploration companies and how it.
But don't forget that most exploration companies are tiny, but they're sub 20 million, right? And if there's been a sort of downward decline for the last 3 years, 4 years in terms of share price, you got a lot of people maybe underwater, a lot of people resistant to selling at a loss. That seems to be a real feature, characteristic of retail investors. They don't want to admit the loss, or they don't want to take the hit. And there's this whole shows about the hope that things may change with the next drill bit, etc. So, and that kind of means that there's not a lot of stock going out there in the market, and it's not, and if there is, it's going to just drive the price down rather than drive it up. So I think a lot of companies, in terms of the market cap, in terms of the share price, are kind of held up by this lack of preparedness to accept a loss. It's like in lots and lots of examples.
There are a lot of shares going out into the market, and I think if you look at the share change in share price, yes, over the last 3-4 years, we've seen it drifting down. If you look at the market caps, if you go back and actually calculate all those market caps, they've been less on the downward trajectory. They've kind of been holding. They're bouncing around. There's a lot of volatility, but for the most part, they've been far more buoyant than the stock price itself. And I think that has to do with all the money that's being raised and all the dilution.
You're talking uranium. So I'd wandered off into across the market, which it has been very downward, and has not been a lot of liquidity for most of them. So sorry, well done for bringing it back to uranium again. Okay. Well, here's one for you then, in terms of acceptable dilution levels for sort of each stage or each phase of the uranium junior exploration. Whether it be first pass drilling or discovery follow-up or maiden resource or whatever phase they're at. Do you think there's this sort of if you were the investor or if you're the company, you would expect the dilution to be running at?
The challenge on the exploration side is that we keep getting told, usually by the bankers, they're making money on all of this, is when the money's available, take it. take all you can, take as much as you can, fill the
Yeah.
bank. If it's available, take it, take it, take it.
Yeah.
Because if you don't, and you need, well, that see, so the problem becomes if when you do see these massive raises, all of a sudden you do see the spending go up as well. A lot of the spending go up, particularly if we're talking about flow through shares, because those have to be spent within a particular period of time. I like to think we've been a little bit more careful in terms of raising money when we need it and as we need it. And again, this goes back to the fact that we've got enough projects that are in the hopper and that are moving along and that are being supported by other partners, that we can be a little more careful and surgical about how and when we raise money. And we never seem to be right when we're trying to project where we think our stock price is going to be, and we're going to get, if we wait, we'll get a better price. But I think we've done more raises for less money than one great big crazy raise when something comes available. And I mean, what's the right approach? I guess the high risk approach is not raise it when you can get it, but you create a massive amount of dilution. We've seen a lot of that over the last while. This is an incredible amount of dilution in the exploration side in uranium on a lot of companies that have raised massive amounts of money, but at not a great price.
And it's tough. It's been tough. It's been really tough for there've been moments in the uranium space, in the last 4 years where it has been really good. But most of the time it's more and more expensive for sure. So you raise a great point there. And we did a show with Brandon Monroe, I think probably a couple of years ago, probably 3 years ago. We were talking about when is the right time to take capital, and I think he and I are of the view that you take it when it's there because you don't know what's coming around the corner. Sometimes you look back in a year's time and go, man, that was genius. But at the time you're getting a lot of grief for it because people think, oh man, why would you raise money in a market like this? Because it might get a little bit worse and the money might get a lot more expensive, and we've got to keep moving. That's why, and that's been the shape of the market for the last few years.
Trying to time the market is difficult for us as it is for an investor.
Yeah. I mean, so here's one for you. I think came out of that conversation, which was around how do you think? Oh, it'd be hilarious. I almost want this to happen, which is, do you think companies should disclose a kind of detailed quarterly cash flow model in their investor decks?
Well, we do.
No, believe me.
Not in the kind of detail. Not in the kind of detail I think you're looking for.
Yeah, exactly.
Yeah. No.
Like I want to know, are these guys?
Not the kind of detail ethical, I get.
Yeah, the detail you get, but no, I'm talking about like ethical reporting. And go, yeah, we spent $30,000 at some conference in I don't know where. Pick up. I better not pick on any particular conference. And yeah, we had some really nice dinners. And yeah, we did fly business class. And yeah, we went and did gorilla watching while we were there, whatever the heck. By that was an actual example. I first moved into the States. Do you want to come down to this conference? We were then going to go gorilla watching after the conference. Oh, yeah, fine. No, thank you. But it's all on the company, so it doesn't really matter. Do you know what I mean? The whole thing's just like is extraordinary. So I think when you talk about dilution, you've got to talk about behavior. You've got to talk about decision making, the right decision making at that, and you wonder why some companies.
I don't think you're ever going to get to that level because it would have to be regulated. And the fact is, it's the things you're talking about aren't material in the sense of the word material when from a reporting standpoint. So. Right now we have to report certain salaries. We have to report, who owns shares and who owns a lot of shares. And there's a lot of reporting around that. But, and that's probably one of the easiest things to look at is what are these people paying themselves? That's probably a bigger nut than that conference they went to, or well, maybe not. But it's something to keep an eye on. You can tell. You can look at a P&L from an exploration company, and you can tell what's going on. It's you can pull out your exploration costs, and I think we've said this before, is the cost of running a public company doesn't all that change. So the things that are really variable is what are you paying your non-technical staff? What are you paying for investor communications? What are you paying for travel? those are kind of the big variables that you can dial up and dial down, and that in many cases just take up too much space on a P&L. And so it's not impossible to look at those numbers and go, this isn't how you run a company.
I'm going to go, and I imagine there'll be a lot of humming with people watching, listening, or reading this as well, because I think it's their money, and I do think stuff like that is not material in the context of drill costs, but it's material in terms of attitude to shareholders' money, which leads me nicely on to, I'm getting really good at this, insider ownership levels and true alignment with shareholders. The amount of CEOs say, "Oh, we're aligned with shareholders." I'm like, pal, you get a big salary, you get your costs and fun times paid for by the shareholders. And some people even have consultancy fees, which they charge the company as well as their salaries, and all sorts of options and all sorts of ways to get remunerated way ahead of the shareholders. So I don't think there ever is true alignment unless someone's taking no salary, has bought their shares in the market. So I'm not a lover of that phrase. So how do you think that management or insiders should show proper alignment with shareholders?
Well, I don't think it's proper alignment for, and again, it is that balancing act you're talking about. It's how many shares have you paid for and owned and cut a check for, like our shareholders have, as opposed to ones you've been given or options you're carrying and. But again, you're also talking about people that are employed doing this. This is what they're doing for a living. And this is how they're earning a living from one year to the next. And they're running a public company, for crying out loud. And they're managing people and staff and shareholders and all of the stuff that goes along with that, like the legals, the accounting, the deals, the partnerships. And so that's the job. So, for shareholders will very quickly run to, well, you shouldn't be getting paid a salary. You should just be sitting on all the shares that you paid for somehow. And that's not appropriate necessarily. But it's
the phrase, I know it's me, we're aligned with shareholders. You're not.
You're not.
You're employed by the shareholders to do a job. And there's nothing wrong with that, because everyone wants to be paid for their time and efforts and experience and skill sets and all the rest of it. So we are employed by the shareholders to do a job for the shareholders. We, as part of that remuneration package, it looks like the following. But and I know all too often, management teams have been incentivized against ludicrous deliverables, such as getting the drills out on time, on site, getting a PEA done. It's like, sweet Lord, that's literally your job. That's it. But to be remunerated, you will get X amount of options if you get that out on time. It's like,
you're talking about information that's publicly available. It's not hard, and we've done it. I think we've had sessions on it where you can sit down and line up everybody's compensation in that C-suite and figure out who's getting paid what, and it's not hard to see that the disparity. Like if that's the thing that's keeping you up at night, that's some of the easier information to get a hold of out of a management information circular once a year. Vote
with your feet, or in this case, your computer, and say you don't like it.
That's all you really can do as an investor, right?
Yeah.
I mean, too much time is spent, sending mass emails and tweeting and stuff like that, rather than just invest in something else. What
do you think of these kind of performance warrants? Tied to these kind of various expiration milestones. Do you think it's warranted?
You mean the use of warrants or the use of options as a compensation?
Yeah, options, warrants, whatever. Because they're kind of, I guess, slightly creative. I call them performance warrants, right? Where you say, right, if you do your job, you'll get. If you kind of deliver against expiration milestones, you'll get more rewarded than just your basic salary.
I think yes. I think they are warranted and they need to be used. They need to be used creatively and properly by these companies. that can't, because the alternative is to they should be compensating for the cash component that's not being paid, right? I mean, if you're talking about a CEO who's running an exploration company, who is handling tens of millions of dollars a year, who is looking after a public company, it's regulated, it's audited, you're doing transactions and deals and this and that and the other thing. You're probably, from a cash component size, you're probably underpaying that person as
Compared
from
to
a
what?
base salary standpoint,
Compared to who?
compared to if that person was doing that for a different company. I mean, that's the way it's meant. I mean, that was the whole reason why, especially in the venture, why there's those options are set up. They specifically say this is to recognize the fact that the junior companies don't necessarily have access to the capital and cash necessary to pay the professionals that they need to hire to run these companies, the lawyers and the finance people and on and on and on. So we're supposed to be using options for that purpose. Now, if you're doing both and you're doubling down, I mean, again, it's all publicly available. Take a look at you can see what it is. If you think it's outrageous, then again,
I do think it's outrageous. I've just been through this process with 3 sets of accountants, lawyers, and auditors in the UK, Chile, and Canada, and I'll tell you for free, the Chileans were slow, but it was kind of reasonably priced. The Brits just did it on a kind of flat fee, and the Canadians, man, they knew how to suck blood out of a stone. And it feels like a kind of cabal between them. They could like make up the numbers as they go along and string it along. It was painful and expensive, super expensive in Canada, and that's what kind of worries me about some of the Canadian behavior. There's a kind of there's the mining clique, and they know how to charge for what they do, and and those sorts of things. To say, well, compared to everywhere else, it's it's good business. Any students watching this, or anyone thinking of what career they're going to, go into mining. It's fantastic. Lawyers, accountants, auditors.
It's easy. It's the money's everywhere.
It's easy. It's easy. Yeah, I get. I didn't realize Canadians did sarcasm. It's very good. Well done. We're making an honorary Brit yet. Okay. And what about things like the impact of legacy cheap paper on financing negotiations? That's another thing that sort of happens. Do you approve? Or do you think it's needed?
You talking about warrants that are still outstanding and things?
Well, just there's also sort of like if you're trying to entice people and get people aboard, whether it be on the financing side or recruiting people, there's always some legacy paper lying around, which and I think retail often accuse management of getting the 2 cent, the 5 cent stock when the stock is currently sitting at 15, 20, etc. It happens, right? Is it a useful tool for you? Do you think that's a reasonable thing to use?
Well, there's a kind of an expiry date on the value of that stuff as well. I mean, it is interesting when you're watching newly minted companies come out of the gate. That's what you have to watch for. It's not just legacy. It's what are they doing? How are they creating it? Who's holding the paper? How did they get it? Are they doing anything for it? I mean, we've had to. I know in Canada they've clamped down a lot. The exchanges have clamped down a lot on these on the shell companies that we're allowed to set up, where your board of directors gets paper at a fraction of the cost of what you're going to go out at, which is fine. There's all kinds of justification around that. But what was going on is the whole notion of it was you're setting up a proper company with a proper board, and you're getting all the shareholders in place, and you're getting the structure in place so that you can roll a business into it easily. And when they were looking around, they realized that all these boards were just made up of rich old white guys who could barely find the door to get out of the house in the morning, who was a buddy of whomever, and it wasn't doing anybody any good. it wound up to be, one person who was somehow steering all this value into their pocket. And so there's been a lot, and this has been going on for the last 5-10 years, I think, where you see this tightening of not just anybody can get on the board of a company of these exchanges anymore. They're vetting you. They're making sure they want you to have some experience of some sort. They want you to have a background in whatever it is you're doing. But there's a lot more rigor being put around whether you're on, and they're out and out, saying you can't be on a board. This guy that you want to put on the board, he can't be on the board. And I've actually stepped into a couple of board positions because, in those situations where, they're getting ready to rock, and the exchange has said, I don't think so. Your grandmother cannot be on the board.
Granzy's awesome. She knows everything. So I love the thought of that. I think we should. Right, one. I think time suggests that we need to move on because you're heading up to site, aren't you?
I'm heading up. Yeah, we've got. We were up there with Chemical up at site last week. We're getting ready. We've got our committee meetings this week, and we're also meeting again with ISO because we've got plans. We're moving up there shortly. So yeah, I'm out in Saskatoon for the next week or so to
busy
agreement and what's going on.
Get you and all of your drill budget. Well, and money.
Money.
Quite nice.
Yeah.
So we talked about a bit of that today. Well, let's kind of pick up on, like I say, we'll do episode 3 next week, but we might kind of just stick with the kind of that whole kind of spending and capital structure type stuff when we kick off next week. Let's see how we go. So I've got to go. You've got to go. Yep. Thanks so much, and we'll speak to you next week.
Thank you. Ciao.